Schulz is a former ECB economist who's now senior economist at Berenberg Bank. Joins me in the studio now to explain his thoughts. So, 2 trillion euros would be a good thing?
2 trillion would be very impressive because that would cover the refinancing costs, or the refinancing needs, rather, of Spain and Italy for a long time. But 2 trillion would mean a lot of leveraging. I think this leveraging is not going to come forward.
Why?
The Germans are quite obsessed with not putting too much taxpayer money up for these risky countries. Also, France has the disadvantage that they might lose their AAA rating, so both countries might need to limit the leverage there.
Christian, as you know, we are seeing the markets rally on reports that we could see a boost for the EFSF, not $2 trillion, but not 2 trillion euros, I should say, but $1.3 trillion. Potentially combining the permanent and temporary rescue funds, and that would basically go ahead from about the middle of next year, 2012. What do you think about that? Is that enough to satisfy the markets?
Again, this sounds very good, but I still think that there is a very low likelihood of this happening, because this would essentially mean that Germany would have to step up its guarantees or double its guarantees, and the German parliament is not going to like that at all. So, and Germany hasn't even voted on the ESM, on the permanent rescue mechanism yet. So this is going to be extremely difficult as well.
So we're not going to get, according to you, Christian, we're not going to get 2 trillion euros. We're not even going to get $1.3 trillion because of the reluctance on the part of the Germans. So what is the alternative? Because right now everyone's agreeing EFSF needs to be beefed up to be able to help the banks withstand any losses, and of course to be able to ring fence Italy and Spain. So how are they going to do it?
In the end, the key to the whole rescue is the ECB. The ECB is the only institution that has unlimited firepower and could guarantee Italian or Spanish or any country's debt if they wanted to, as long as they are satisfied that these countries are making sufficient reform efforts. So it's all down to the ECB. Now, the ECB is unlikely to say next week, yes, we are going to step in and we are going to do everything that's necessary. If they did, I think we have a good chance of resolving the crisis. But unfortunately, this is going to take a few more months of turmoil, I'm afraid.
How much more turmoil do you think we will see in order for the ECB to morph into a lender of last resort, or to at least accept their role as such?
Well, at the moment, in terms of the real economy, we are not in a recession yet. But I think most of us would agree that we are heading towards pretty bad economic times, and we could enter a recession. As soon as the real economy is really tanking, the ECB has to do something, and that would add to the pressure on the ECB to do what it needs to do, what is its responsibility, and then the ECB will step in. So it's going to take a few more months until the hard data is bad enough for the ECB to realize that it has the responsibility to resolve this crisis.
Now, of course, the other thing on the table, they're discussing deeper losses for Greek bondholders in a revamped sort of bailout, if you like, with an upward revision on the current haircut of 21%. It seems that you're saying we're not going to get anything substantial on the EFSF. Are we at least going to get some agreement on an upward on private sector involvement in taking losses on their Greek debt holdings?
Well, the pressure there is pretty high. The Germans really want this. It's going to go into the direction of 50%. It looks more and more likely that we're going to not just see voluntary involvement, but some sort of forced involvement of the private sector, whether that's forced on the face of it or forced in the sense that banks will say this is actually not voluntary anymore, is up for question. The Troika report on Greece shows that Greece is in a very bad situation. So economically, it would make sense to lower the debt level. But of course, we have to keep in mind the contagion risk. Without any sort of backstop for the rest of the countries in the Eurozone, this haircut on Greece is going to have negative effects.
Such as, you're talking about it impacting appetite for sovereign bonds?
Well, Greece, in the eyes of the European politicians, is a special case, but in the eyes of the markets, it's a precedent for what happens to other countries. So if Greece defaults, we're going to see, again, speculation on Portugal, possibly Ireland, Spain and Italy also defaulting, and that's going to drive markets for these bonds lower, yields higher, and that would then become a self-fulfilling prophecy again, and would again raise the pressure on the European politicians, on the ECB to intervene.
Speaking about the EFSF and its enlargement, I'm just wondering about, because you're saying that it would be one potential solution, you describe it as a bazooka, but to what extent does that, because when you speak, you're talking about the core countries like France and Germany essentially underwriting some of that risk taking on liabilities from indebted Eurozone countries. Further down the line, this would be a bazooka now, the expansion or magnifying of the EFSF, but to what extent does it endanger the fiscal position of those countries, the core countries, say, in a few months' time?
It's a very important question, but it is really a two-sided thing. On the one hand side, if you increase the firepower of the EFSF, of course the risk for countries like France rises that they are going to see a downgrade. On the other hand, if you resolve the crisis doing this, then the risk of all countries actually goes down, and in the end it's good for countries like France, also of course for Italy and so on. So it's a two-sided sword. The problem with the EFSF is, even if it goes up to 2 trillion, if the ECB doesn't complement it with its commitment to resolve the crisis if need be, then it's probably not going to be enough even with 2 trillion, because if markets really test, the EFSF eventually is going to run out of firepower, or it's going to get run out of firepower at a very fast rate. Markets are not going to like that, and in the end it needs the ECB to guarantee that the EFSF will be enough. If the ECB steps in, maybe the EFSF will be enough. Maybe the ECB will never have to actually do something. But if the ECB doesn't, it says we're out of it now. It's the EFSF's responsibility now to buy government bonds. Then the EFSF may be tested and may not suffice.
Can the EFSF afford to buy government bonds in the secondary market?
That's another good question. We have the discussion on the guidelines for the EFSF at the moment. What exactly can it do? How much can it commit to each individual program? It has different powers. It can recapitalize banks. It can intervene on primary markets. It can intervene on secondary markets, or any combination of the three. So it may well, in certain circumstances, intervene on secondary markets, but it may not be the wisest thing to do that right now.
Let's just pick up on one of the points that Linda was making there, Christian, because you were saying one possible silver bullet would be a beef up of 2 trillion euros. But then what about Germany's concern that this would potentially compromise the ECB if they were to indeed lend large amounts of money to the EFSF?
Well, this is the blocking stone. I think the French proposal to have a bank license for the EFSF would be the simplest and best way. It would involve the ECB, and we always say the ECB is the ultimate backstop. But the ECB has the tradition of building on the old Bundesbank's reputation, and Germany also reversed this old Bundesbank reputation. They simply don't like the ECB or the central bank being involved in government financing. So this is the stumbling stone, and this is why this idea is probably not going to fly.
Christian, can I kind of pick up on this? When you were at the ECB before, now is the main concern that if they were to lend lots of money to the rescue fund, expands the ECB balance sheet and it could be inflationary?
Exactly. The fear at the ECB is always that in the longer term, whatever action they take now may have an inflationary impact. But they may be wrong on this one, because actually in a financial crisis, liquidity demand goes up. So if you raise supply, that doesn't necessarily lead to inflation. It just satisfies the additional demand for liquidity.
Based on what we know right now, how far apart are France and Germany when it comes to leveraging the EFSF? Because we've been getting mixed messages on this all week, and there is so much anticipation building up to the summit. I was in Paris for the G20 finance ministers over the weekend, and everybody you spoke to there kept on saying, wait till the leader summit, wait till the leader summit. But are the divisions in fact widening?
Well, it could be that the French are really trying to bargain a little bit here. I think the idea of turning the EFSF into a bank is pretty much, as I say, it's pretty much dead. The central banks don't like it, the Germans don't like it. So what's the interest for the French? Well, they could pressure the Germans into giving them concessions on other questions, on the bank recapitalization, for instance. So I think maybe they're actually not that far apart, but they keep the pressure on each other until the very last moment, which is typical in these European negotiations.
Also, Linda, what do we expect to get, and Christian, get your thoughts on this, what are we expecting to get with regards to bank recapitalization?
Well, I think what we know is that they're estimating now what banks would need to, say, survive a haircut, a big loss on Greek debt. What we're not sure, of course, is the size of the haircut. So the European Banking Authority estimates it could cost up to 100 billion euros. Now, I think there's an interesting debate here, which is that should the EFSF recapitalize banks, or should it actually be the national governments? But I think the problem is, and Christian, I want to bring you in on this, is can you really ask cash-strapped governments to then recapitalize their own banks? But if the EFSF were to do this, how much firepower does it actually have left? And it's got to buy government bonds, it's got to provide credit lines. I mean, it's a lot to ask.
That's true. The EFSF, if it were to do the whole 100 billion euro recapitalization, would obviously fire away already a quarter of its capacity. That's not good. So the first line need to be the governments, and the major governments, Germany, France, maybe the Netherlands and these countries. I mean, they should be able to recapitalize their banks themselves, and then it leaves maybe Spain, maybe the smaller countries to use the EFSF for that recapitalization.
If they do it on an individual nationalized basis, what does that mean for the level of debt that they're then taking on? What does that mean for their fiscal position?
I think that is the crucial issue. It might even be an issue for France. I mean, we heard this morning that it's in danger. S&P put out a report of losing its AAA credit rating. So I think these are certainly things that are weighing down on the summit. Actually, could I ask Christian a bit about the Nemazee interview, which is an exclusive on Bloomberg TV? There was a really interesting phrase he said there, which is, of course, it's not the ECB's role to do any of this. And then Francine actually asked him about, what about a rate cut? Are there, what does this mean for the next move of the ECB? And he said, we need to see the forecast. That doesn't come out until December. So does that mean no rate cut next month, no rate cut till the end of the year? It'd be great to get your thoughts.
Well, it's very likely that this will happen. We have to keep in mind that Novotny is more part of the German bloc within the ECB, which is a bit more hawkish, obviously, than other parts of the governing council of the ECB. But still, Draghi takes over from Trichet in November. That makes it less likely that they will announce a rate cut immediately, because he has to gain credibility as an inflation fighter first. Then we have the forecasts also in December. Plus, the economic data from Europe is not very good at the moment, but we are not in a recession yet. So a rate cut could come a little bit later once the data has even turned worse.
And just going back to this issue of bank recapitalization, right now we're hearing about we're likely to get something in the region of 80 to 100 billion. And actually what we keep hearing is there being a 2 billion euro shortfall. So even that is potentially not going to be enough to satisfy the markets, is it, Christian?
Well, markets are, this is a two-sided sword, because the banks don't like this recapitalization plan. They've said that they would rather shed assets than take on additional capital. That's leading to a credit crunch. So that's also not very good. You don't want to have too much recapitalization. It's difficult to say what exactly markets want on this side, actually.
Whatever emerges from this summit, as long as the ECB stays in the bond market, will the situation be kept under some control? Because right now we're seeing yields creeping ever higher. We're looking at the 10-year Italy bond at above 6%. So if the ECB stays in the market, will things be okay regardless of what happens this weekend?
The ECB has only bought 2 billion, about 2 billion last week. So that obviously doesn't support bond prices very much. If the ECB credibly commits that they will stop any market panic, I think we have a big part of the problem resolved. The other part is back down to the governments. They have to go through the reform processes necessary, and that's what the ECB requires in the end as well.
Good stuff. Well, Berenberg Bank senior economist Christian Schulz, thank you very much indeed. Good to talk to you. You've been very patient sticking around. Linda, thank you as well.